Want to master bond investing? Start by learning these 12 crucial terms. Today we're diving deep into the world of bond investing. If you're looking to understand bonds better and make informed investment decisions, you're in the right place. We'll break down 12 essential terms every bond investor needs to know. Just keep in mind, this video is for informational and educational purposes only. It should not be considered financial advice. Always discuss any financial decisions with your financial advisor to determine your best strategy for your individual needs and goals. Let's start at the beginning. What is a bond? Simply put, if you buy a bond, you are lending your money to the entity that needs to borrow it. That borrower could be the U.S. government, a state, city, or some other local government entity, a U.S. government agency, a corporation, a homeowner, just to name a few. You lend this money to them in exchange for regular interest payments and the return of the bond's face value at maturity. So first up, face value, also known as par value. This is the amount you'll receive when the bond matures. It's usually set at $1,000 for U.S. bonds and $5,000 for municipal bonds. Keep in mind that this isn't always the dollar amount you paid for the bond. Depending on the market, those amounts may be different. Our next term is maturity date. This is when the bond's principal amount is repaid to the bondholder. Bonds can range from short-term, a few days or months, to long-term, 30 years or more. I've even traded bonds issued with 100-year final maturities. Next, we'll talk about the coupon rate. The coupon rate is the interest rate paid by the bond issuer on the bond's face value. It determines your annual interest income. Unless you're buying a variable rate bond, this interest rate never changes no matter what is happening with interest rates in the market. So these are the 4 key features every bond you buy will have. The issuer, U.S. government, a corporation. We'll go into more details about some of the different issuers in future videos. Next is the face value, the amount you receive back on your final maturity date. The maturity date, that's the date you'll receive both your final interest payment and your face value of the bond. And last, the coupon rate, the periodic interest rate that you'll be paid for the bond. The next term, yield, is where we can see some confusion. So I'll be sure to include some examples to help you better understand the possible differences. A bond's yield is the return you'll earn on the bond expressed as a percentage rate. It takes into account both interest payments you receive and up or down price changes between the price at which you're buying the bond and the price you'll receive at maturity, or the par or the face value. The next term is bond price. This is how much someone is willing to pay for the bond, stated as a percentage of the face value. For a newcomer, this probably seems really confusing. A bond has a $1,000 face value, right? Why would someone pay more than $1,000 for it? Or why would someone be willing to sell a bond for less than $1,000? Let's dive a little deeper in on this one. Here we'll introduce 2, we'll call them subterms. They are premium bond and discount bond. First, a premium bond is sold for more than its par value. A discount bond is sold for less than its par value. Let's take a bond that has a 5% coupon rate and comes due in, say, 5 years. You know that you'll receive that 5% interest payment every year for the next 5 years, and that at the end of the 5 years, you'll get paid the bond's face value, $1,000. Let's say that in the current market, you can buy a 5-year bond of the same quality, but get 6% in your annual interest payment, and that bond would cost $1,000. So if you could get that bond paying 6% for $1,000, you wouldn't pay $1,000 for a bond that only pays 5%, right? In order to get a 6% return on that 5% coupon bond, you would only pay $957. The difference between the 5% and the 6% coupon is made up by only paying $957, but receiving the $1,000 face value at the end of the bond's life in 5 years. I'll put a link in the description down below to an online bond calculator so you can play with this sort of calculation yourself and get used to it. Before we hit our next term, if there's a term you're curious about that we didn't discuss here, let us know in the comments section below. This leads us into our next term, interest rate risk. This is the risk that bond prices will fall because interest rates are on the rise. Remember, bond prices and interest rates move inversely. When interest rates go up, bond prices go down. And when interest rates go down, bond prices go up. This is always the case. We'll touch on one other type of risk associated with bonds while we're talking about risk, but first we need to talk about our next term, bond ratings. Bond ratings are provided by independent third parties like Moody's, Standard & Poor's, and Fitch. They assess the creditworthiness of the issuer. On the screen, you'll see all of the long-term ratings provided by the three primary rating agencies. The ones in green are what we consider investment grade, and the ones in red are the ones we call junk. Just like you get a credit score and someone can quickly assess what kind of credit risk you are, these credit ratings do the exact same thing for bond issuers. In other words, what is the likelihood that the issuer will be able to make timely interest and principal payments well into the future? Feel free to pause the video to give yourself a little time to digest and familiarize yourself with bond ratings. Bond ratings are one of the most important things to look at when you're considering what bonds you're going to buy. Bond ratings relate directly to our next term, credit and default risk. This is the risk that the issuer might not make interest payments or repay the principal. Higher rated bonds have lower credit risk. We'll break down some more of the risks related to bond investing in other videos. This is a great place to discuss a term we often hear in the news, junk bonds, also known as high yield bonds. These are lower rated bonds with higher default risk. They offer higher interest rates to compensate for that risk. When you see a lower rated bond with a higher yield or rate of return, understand that you may not receive that stated yield because there is a reasonable chance the issuer may not be able to make the interest and principal payments for the entire life of the bond. Just keep in mind with junk bonds, don't invest in something you don't completely understand. If you're finding this information helpful, please give us a like so that others will know this video is worth their time. The next term we'll discuss is call features. Some bonds can be redeemed by the issuer before maturity. Now, don't mistake this for something catastrophic. You're just receiving your face value earlier than expected, and you're no longer going to earn interest from this issuer on this bond. Some folks who are new to bonds mistake this as a default, meaning they're not going to earn any more interest on this bond, which they're not, and they're not getting paid their face value, but they are. Issuers might call bonds when interest rates drop so they can refinance their debt at lower costs. Our next term is yield curve. This is another term that you will see referred to a lot in the financial reporting. The yield curve plots interest rates of bonds with different maturities but same credit quality. It can indicate economic expectations. A typical yield curve will have lower interest rates for shorter maturities because there's a lot more uncertainty between now and when your bond matures in, let's say, 30 years than there is when the bond matures in 3 years. We expect to be paid a higher interest rate for a 30-year bond than we do on a 3-year bond. Now that you understand these key terms, let's talk about how to get started with bond investing. First, determine your investment goals and time horizons. Research different bonds. If you use a platform like Fidelity or Schwab for investing, start to look at some of the offerings that are available. Begin to look at some of the features we've discussed in this video, things like the issuer's name, maturity date, the coupon rate, the yield to maturity, yield to call, the rating. Get comfortable looking at the different types of issuers. See what fits some of your cash flow and investment needs. In future videos, we'll show you exactly how to purchase individual bonds on platforms like Fidelity and Schwab. For now, stay away from bond mutual funds and bond ETFs. They do not offer any of the certainties that individual bonds offer. Understanding these 12 key terms is crucial for any bond investor. From bond basics to risks and benefits, you're now equipped with the knowledge to make informed decisions. Remember to align your investments with your financial goals and risk tolerances. If you found this video helpful, I hope you'll consider watching one of these videos where we discuss specific bonds in more detail. Thank you so much for watching.